When stock markets and economy decouple, what should investors do? The first question should be, are stock markets and economy actually decoupled? We will ask our panelists about this. The RBI governor seems to think so because he suggested that there is a disconnect between where the equity markets are and where the economy today is. In the US, we are seeing joblessness numbers showing a very different trend and corporate earnings showing a very different trend from what the stock markets are suggesting. So in both the countries, we see similar trends of the stock markets doing well, but at the same time, the economy indicators showing other signals. I'm going to stop here because I'm not the expert here. I'm just the guy who'll ask questions on behalf of all of you. There is a Q&A session at the end. The Q&A box will be available to you throughout. I'm constantly monitoring the Q&A box. Feel free to drop in questions at any point of time. I'm constantly keeping an eye on that. Today's session is called a fireside chat. It's a virtual fireside chat. We have someone sitting in the US early in the morning. We have Bhat sir and me sitting in India amid proper rains and blackouts happening across the country because of the kind of weather we have been seeing. At this point of time, a fireside chat is basically just to get not a fiery debate going, but to ignite a few flames of thought to help our investor friends navigate what is clearly a very confusing time for investors when the economy is behaving very, very differently. Let me just quickly introduce our panelists to you. John Reese is the founder and CEO of Validia, as Prashant has already told us. He is the co-author of the investment book, The Guru Investor, How to Beat the Market Using History's Best Investment Strategies. He holds an MBA degree from the prestigious Harvard Business School and a bachelor's degree in computer science from the Massachusetts Institute of Technology. Mr. Bhat is one of India's highly acclaimed investment managers, having managed foreign institutional investments in the Indian market over multiple decades. He has worked with Jardine Fleming JP Morgan as their CIO. He has been the MD of Dalton Capital's India arm, and among numerous other accomplishments in capital markets, he's also been closely involved with formulating policies for benchmark indices for Stock Exchange Mumbai as part of their index committee. Trust me, the briefs for both these people would be much longer, but we don't want to talk about them. We want to hear them talk. Because I left it on the topic of indices, which is what Bhat sir has been helping the Indian markets do. But sir, our Nifty is currently scaling 12,000 and GDP forecasts are at negative 10%, even from the Reserve Bank of India. How do you look at this dichotomy playing out? And should investors brace for a significant market correction?
Well, if you really see, when the pandemic hit the country in March, the market collapsed by almost about 40%. It was at about 12,400 and came right up to about 7,400 on March 24th. So since then, the market has recovered quite a lot, and it is now within kissing distance away from the historic highs, probably about 6-7% below the historic highs. There has been a lot of gyrations, as you see, as you have seen in the market, and numbers that are coming out on the economy, like say for example, the first quarter GDP number was minus 24% year on year, which was something that disappointed a lot of people. But there was really nothing much to get disappointed about because the whole country was under lockdown. But even now, the IMF and so many others seem to be suggesting that FY21, that is April 20 to March 21, be probably somewhere minus 9-10% sort of GDP growth. So against this, we are seeing the market really revive quite a lot from its March 24 lows. And there is a feeling that there is a complete disconnect between the GDP numbers and what the market is doing. And there are a lot of people who keep saying that the market is on a trip of its own. It doesn't have anything to do with reality. It is market is for the rich people who play like in a casino. And that is why it goes up. So it has nothing to do with the reality where there is almost so many factories are closed. There is so much of joblessness and there is so much of medical emergency. So I think we need to connect these two. Why exactly is the GDP number expected to be so bad? But at the same time, the market is very high. The fact of the matter is that in India, if we talk about India, India has about 6 crore business establishments. And out of the 6 crore business establishments, less than 1% of the 6 crore, that is less than 6 lakhs, have businesses which employ more than 20 people. So a large number of small businesses is what characterizes the Indian economy. So now, as far as the stock market is concerned, stock market represents the more successful, the larger, the more formal sort of employment generating companies. So, and even if you take the whole sales of the stock market listed companies, it is less than 50% of the GDP of the country. So now these large companies typically have some sort of much more resilience than the small guys. The small guy, the small entrepreneur, the roadside vendor, the transport operator, the small kirana shop, these people are unable to withstand the lockdown because they cannot travel here and there, they cannot procure their goods, people don't come to their shops, so they have virtually closed down. Whereas the large companies are having some resilience because quite a lot of them can work from home because we have good data connectivity today. So therefore, like say, for example, you saw the IT companies coming out with stellar results, basically because most of their employees are able to work from home and continue to keep the sales register ticking. Whereas the small companies really cannot do that. So therefore, what you have seen is the small companies and the small entrepreneurs and small businessmen are the ones who are suffering. That gets reflected in the GDP. So the market is actually reflecting what is happening to the larger companies. That is one part of it. The second part is that if you really see, the larger companies are the ones who are able to withstand any sort of pressure quite well. At the same time, they are in a position to continue to work. And the stock market as an index, if you really see, it actually discounts the future of the economy, future of the company. So, and if you see the value of a company, value of a stock, it represents the discounted free cash flow during the life of that company. So now, if you really see the discounted free cash flows over the next, say, for about 20 years, then quite a lot of the value comes out of the free cash flows that are generated after, say, 2 to 3 years. So therefore, if there is a problem about free cash flow in the first year, it doesn't mean that the company ceases to exist. As long as the company is resilient and it can continue, so there might be certainly some correction that is required because the first year or probably 1.5 years free cash flow is gone for a toss. But the rest of the business, as long as it continues, is still there. So therefore, there is no reason why a company that is expected to continue to perform, if there is some sort of an adversity in 6 months or 1 year, it should collapse in price. It will continue. And at the same time, you have seen that some of these IT companies, the telecom companies, these companies continue to do very well. So therefore, it is not to say that the stock market is on a trip of its own. It really represents what the market thinks. The market really thinks that this pandemic we might see the back of the pandemic probably in the next 2 or 3 quarters, and after that things will be back to normal, and that is what gets reflected in the price. And that is why you see there is an apparent dichotomy between the way the market is functioning and the real economy, but it can easily be explained.
Thank you so much for putting this whole conversation into context. Let me try and bring John in here. A lot of our people who have logged in are from India. So if you could just give the investor friends here a recap of the market and the economic situation in the US over the last 10 months, when we have clearly been navigating a very bad pandemic period. John, sir?
Yes, I could. Let me just say that Bhat and I have not compared notes, but it is amazing that I could have said almost identically what he has been saying about the Indian market has been true about the United States market and the decoupling or the apparent decoupling as well. So I'm going to make a number of points, and it's actually going to sound just like Bhat had said for India, despite the vast differences in the economy. Over the last 10 months, we've seen one of the fastest waterfall declines in the U.S. stock market the entire history, and then an extremely fast, by historical standards, recovery. For example, the S&P 500 itself was down 30% from January until late March, and then since then, it's up 52%. Those numbers were very, very close to what the Indian economy, or I should say the Indian index had jumped down by. We've seen in the United States massive, historically unprecedented government stimulus. The Federal Reserve has initiated quantitative easing. They've bought massive amounts of bonds. Not only that, for the first time, they bought corporate bonds, and they bought for the first time in the US stock market ETFs or traded funds. They put in direct stimulus programs. They had programs both for small business and big businesses, although not everybody can take advantage of it. And our debt in the United States has grown over that 10 months from about $2.5 trillion now to $7 trillion. This is huge by United States standards. And at the same time, we still have, by official counts, some 12 to 13 million people out of work. That's off of its high. It was worse than it was in the 2008 recession. We're now down to about 8% official unemployment. Of course, the unofficial employment, people seeking jobs and not able to get them, or they're accepting part-time jobs when they want full-time jobs, is much higher. By those measures, the United States unemployment is still up above 20%. Our Federal Reserve has indicated that our interest rates which are really low right now, are planning to stay this way for a number of years. That is amazing, and allows real estate developers and other types of segments of our economy that use massive amounts of capital to borrow at extremely cheap and extremely attractive rates. All of this means that the government has massively supported the business, and they're not going to stop, although they didn't really pass another $2 trillion in support yet. That's widely expected to happen over the next several months. And the other thing to note in the American economy is that there's some key differences in industries. The technology has been doing exceptionally well. It had before. It has been doing even better since this particular, the COVID attack. But segments of our economy, the airlines, the travel industry, the entertainment industry, it's almost been entirely wiped out. People are still out of work. Movie theaters are still widely shut down. Travel is a tiny percent of what it actually is. So different sectors of the economy are reacting differently. And when we talk further, I'll explain what that actually means for the appearance of the decoupling.
Thank you so much. If I didn't know which economy you were talking about, it could have just been India. Like you said, you and Bhat sir clearly had the same kind of points to make. Thank you so much.
Yes.
But sir, John sir mentioned stimulus. So in 2008, the recovery was led by coordinated central bank action and stimulus driving global liquidity. Even today, we are seeing global liquidity sloshing around. Are developed economies, given the pandemic, in a position to continue with the similar stimulus-led strategy for an extended period? So you're muted.
Well, that is what is being tried out, because it has been successfully used in 2008. And I think we are still not out of that quantitative easing yet. We have not unwound that. And then we have this pandemic. So this is being tried again. But the fact of the matter is that classical economists think that there has got to be some consequence of this sort of quantitative easing that has been going on since 2008. But theoretically, if you really see, a government or a central bank can create enough and more money domestically. Japan being the prime example, because Japan is an over-indebted market as far as the government is concerned. But all its borrowing is from Japanese, from the domestic market. So therefore, as long as they have the power of taxation, maybe there would be some inflation as per theory, but it has not really shown up since 2008. But even if inflation were to be there, you cannot theoretically go insolvent, because you can always tax and repay that. There are always taxpayers to repay your debt. So therefore, that is the sort of system that is now in place, whether it is in developed markets or even in developing markets. In US, I think since 2008, the size of the Fed balance sheet has more than doubled, largely because of quantitative easing. And that process continues, and we are talking of another $1.5 to $2 trillion probably over the next few days. So this sort of printing or quantitative easing that you have seen has brought down interest rates to near zero levels. In most developed economies, interest rates are zero. And when there is more money is sloshing around, that money has to find some return. And so therefore, by lending or by investing in fixed income securities, you cannot get any return virtually. So therefore, they're trying their hand at equities. And that is the reason why there's so much of money coming into the equity market. And hopefully, and the equity market has really given a very good account of itself. So since the pandemic, as John was saying, the US market has hit historic highs. In India, it is probably about 6-7% away from there, but it's getting there. So therefore, people have made money by investing in equities. So therefore, there is more and more of money coming into the equity market. And so therefore, I think this prescription seems to be working well. At some stage, as per classical economics, it has got to show up as inflation. But if 2008 is any indication, for the last 12 years, we're really not seeing inflation, even though the historically high quantitative easing has happened. So therefore, there may be I mean, there are a lot of economists who say it's time for us to revisit that classical theory where excessive money creation will lead to inflation. It may not be the case. There may be other reasons why it is not really showing up as inflation.
Thank you so much on that one. We will come back to this question later. But John sir, because earlier Bhat sir already touched upon it and you briefly commented on it, but let me just put the question out there to you. What are some of the reasons why we are seeing this decoupling of the markets and the economy? Bhat sir clearly seems to think it's just markets indicating where the economy will go. Or let me just twist the question around and say, are markets decoupled with the economy?
That's an interesting question to answer. It's decoupled from an initial point of view because the markets are extremely, in the US, basically at new highs. At the same time, there's massive unemployment. We've seen GDP down, expected to be down because we know businesses, have been shut. They're not generating any kind of income or profits. So clearly on the surface level, there's decoupling. But I also find it amazing, again, Bhat and I did not at all share notes on this, but we're seeing, I guess, the same general patterns and wisdoms internationally. So Bhat made the point, and I want to second the point, that the stock market also values a company for its cash flows, and those cash flows are for over a long period of time. Only about 5% of the valuation of a company has to do with its current valuation. So the stock market itself is very clearly seeing that, hey, the economies and the companies are going to recover from this, at least most of the companies, and are looking well past what the current short-term economic results are. Yes, they can persist several quarters or a couple of years, but the stock market is discounting that. This decoupling we've seen multiple times in the US stock market over the years. The biggest example of this is one we've been discussing, that the 2008 crash and recession. And what you saw in that was very interesting, but the stock market recovered well before the economy essentially did, and then kept going up and up and up. And it's interesting. One may expect it to crash, yet even after many, many years, it didn't crash. And maybe we'll touch on that point later. Another thing that's really key in terms of whether it's decoupled or not, basically is that the government, of course, has injected massive stimulus, $7 trillion of stimulus into the economy. And a third reason is we observe massive amounts of cash still on the sidelines that are not in the stock market. Some of the greatest investors, Buffett, Tiger 21, has cash that eventually will return and have to find its way back into the stock market. Bhat had mentioned, again, from the stimulus, there's a lot of cash that the economy is awash in, the banks are awash in. That also, they're not finding sufficient returns. Again, the only hope or equity or outlet is stock market equity. So he's quite right about that. So yes, there is an apparent decoupling, but the stock market itself is strongly depicting that the economy is going to basically return to its current level over the next several years and then go on to new highs.
Thank you so much for that. But sir, you when do you see this divergence between the economy and the markets beginning to narrow? When do you see the economy beginning to recover the way we are all hoping it will? Can stimulus tantrums spook markets? Also, can earnings recovery play spoilsport for many of the companies that are currently, touching new highs?
Well, the base case today is that this financial year, that is FY21, April 20 to March 21, is a virtual write-off because even the GDP is going to be negative, probably double digit. And then you probably the first half is a virtual write-off for most companies. So therefore, the second half cannot be so good, even if pandemic were to suddenly disappear, so as to generate some reasonable growth. FY22 will probably be a good year because every day there is some talk of a cure for COVID-19 or a vaccine being found. So therefore, I think sometime it will be found. Sometime we will get over this. But even if you see the numbers in India, new infections per day of about very close to just about short of a lakh, it has now come to the 60,000 sort of bracket. So therefore, there is some sort of, if you're a technical analyst, you will say the moving average is actually pointing downwards. So therefore, there is some indication that probably things under control, but we're still not opened up fully. We're not, say, for example, most of the metros are not open. The suburban transport train network is not open. So all these, when these things open, we do not know whether there will be a second sort of phase. But as of now, it looks like as if things are getting to be under some sort of control. Now, so therefore, the base case is that by early FY22, things will be back to normal. And since the base is very low, it will look like a very robust growth in FY22. And thereafter, I think things should be quite fine. This is the base case. There is a possibility that things, as I said, that when we really open up fully, there may be a second wave of infection, and then things might actually get delayed. The recovery may get delayed, in which case, I think all this hope that is there in the current state of the market might actually change. But as of now, this is the base case, and there is a possibility that things can go awry. But today, it looks like as if things will recover by the first quarter of FY22, and that is what is priced in.
As you were saying, RBI's estimation is 10% minus for FY21, but for April, June, on purely the low base, it's around 21% growth on year. So if nothing else, the base should start kicking in at some point.
Yeah.
So, yeah. John, we lost you for a second, and we gained you back. So just wanted to check, can you hear us? No, you're muted. You're muted. You're muted.
I can hear you now. We lost
sure.
internet connectivity there for a few minutes.
No problem. That's why I just did a quick tech check. John, just to come back, what are the key factors US investors should look at when considering investment opportunities into India and vice versa? How important is it to consider the USD INR currency risk or country risk in the current scenario, where clearly there is a flight to safety in many cases?
US investors should, as a general principle, be diversifying. There's a lot of home bias in most investors' decisions, both here and across the world, that people want to invest in their own economy that they know. But even in the United States, that at most represents 50% of the stock market, and basically, if they want to be properly diversified, 50% should be in other countries. That's rarely the case in the US. So they should be diversified. India is one of the most promising economies, and there should be considerably more investment there than there is right now. The basically the ratio of the exchange between rupees and the dollars is a concern more uh, of the Indian market to the Indian investor, because over the last 10 years, the trend has been down in terms of the exchange rate. And by that, I mean, if an Indian investor puts his money in US stocks and US dollars and just holds it over a period of time, if for the past 10 years, he would have received a several percent per year return just based on that alone. If he had invested in US stock market, there would have been an even bigger return. So from the US standpoint, that's a headwind against it. From the Indian investor investing in the United States, that's basically a tailwind supporting it. And while nobody can guarantee which way the exchange rate is going to go over short periods of time, if the historical long-term trends continue, that's very much in favor of Indian investors investing in the United States market.
Thank you so much. Heartening to hear. But sir, because we're talking about foreign investors, and you've spent a whole lifetime telling foreign investors how to navigate India's complex markets with policy changes, with legal challenges, all kinds of risks that we run. How do you think foreign investors are currently looking at India's prospects based on the various policy measures that have been announced by the government, Reserve Bank of India, monetary policy, liquidity, fiscal, all of these things? How do you think foreign investors are currently looking at India?
Well, as of now, it looks like as if the Indian economy is in reasonably good shape given the state of the pandemic. If you really see, we have not gone around splurging money like so many other economies on non-productive goods. In fact, we've used this pandemic to bring about fundamental changes in the way we do business, like, say, for example, labor reform. Reform in agriculture. I mean, these are fundamental things that have probably not been, they have always been attempted, but there was always so much of political opposition that it was never done. But this has been done this time. So therefore, the path of reform seems to be the right, going in the right direction. There is talk of privatization. I think even today, the government was announcing that there will be more privatizations. And for the first time, you're really talking of a strategic sale. One of these petroleum companies, there is talk of a strategic sale. Government has already put out invited bids for that. So, I mean, these are all dramatic things that are changing as far as India is concerned. On the fiscal side, they have been quite judicious. They have not really spent a lot of money in just splurging, but they have used the banking system to ensure that the small businesses which really need succor, they are given the right amount of credit, the credit needs are met, and the recovery is also sort of delayed. The interest is not being recovered immediately. They are not declared as non-performing immediately. So all these things they're trying to help by using the banking system, but not by actually borrowing more and more money. So that is a very responsible, from an investor's viewpoint. I think these are the right signals that you give. Reform is continuing, privatization seems to be continuing, you're not splurging. But at the same time, interest rates are under reasonable control. They are not. It is not as if they have borrowed a lot, and interest rates have started spiking. It is not so. So therefore, I think on the whole, if you really see, even exports have started picking up now. We have had a current account surplus last month. So things seem to be improving. But at the same time, it has been a very responsible government. It has not really paid heed to all the populism voices that come, populist voices that are coming, saying that don't worry about tomorrow, just keep putting money in people's pockets. It has not done that way, but it has gone sector-wise and really given succor to specific sectors. In that way, I think it's a very responsible government. And if you really see the developed markets, quite most of them are at historic highs. whereas in India it is still not there. At the same time, as I said, that even the impact of the pandemic seems to be sort of getting diluted a bit. So therefore, there is a lot of hope that things will turn around in the next 2 quarters, and that is what is getting reflected in the prices. And I think that is why investors, given that there is so much of money sloshing around because of the quantitative easing, India will find itself as an attractive destination for these foreign investors.
We are seeing, thank you so much, Bhat sir. We are seeing this very interesting thing play out where even the IMF is telling India to spend more and the Indian government is not spending. So this is one of those times where purists are asking for more spending and the Indian government is trying to keep its wallet in check. Thank you so much, Bhat sir, for that. Let me ask the question that most people wanted me to ask John when I told them I'm doing this webinar. John, you knew that Trump question was going to come up sooner than later. So here it is. The US presidential election is less than a month away. The world will be interested to see if America continues with Trump or if the polls are right and Biden will take over. Can you talk about how investors should view these elections and the types of sectors that may benefit from a Trump or a Biden victory? Is there a way to play the Trump strategy different from the Biden strategy?
First of all, the bottom line answer is no, investors should not play the US market election. Among other things, there's a widespread impression that when Republicans win, that's good for the economy and good for the stock market. But when we actually do an analysis, we actually reach the opposite conclusions that under Democratic government, the stock market is actually outperformed when Republican presidents were in control. Now, people can do a further analysis and look at what happens, which parties are controlling the House or not. It is interesting that when the parties are mixed in terms of different parties control the president or the Senate or the House, the stock market actually does better than when one party controls all three. Part of that is that the biggest investors are concerned that when one party controls all three segments, there is such massive amount of spending that will many times well, basically, they're more concerned when that happens, the taxes will essentially be raised. They're not at the moment concentrating the fact that, well, that also means that there's a lot more government spending, which, as you've seen, has made the really key difference here in terms of the reaction of the stock market versus what's actually happening at the moment in the economy. So it is very difficult to handicap the race. It is very difficult to bet on what's going to happen. If you're trying to place a hedge either way, there are very large costs to place either of those positions that almost make it not worthwhile. This is assuming that you could even predict what the results are going to be. Now, in answer to your question, what things will essentially benefit depending on who actually gets elected, there is some widespread feeling, for instance, that if Biden gets elected, pharmaceutical firms are actually going to be hurt, not helped. He wants to, raise taxes, but no matter what, no matter which party gets elected, taxes have to go up to eventually start to balance the budget. With Trump will try to resist that to keep some of his cuts. Biden will attempt to restore some of it. But either way, there's still going to be massive stimulus from either of the two parties, as well as even when our Republican presidential candidates say they're not going to raise taxes, they end up raising the taxes anyway. That's the sad part of politics. Basically, under a Trump administration, it is quite possible that energy will do a little bit better and manufacturing would do better than it would otherwise, because Trump will fight to keep some of those cuts and breaks and lower regulations that he was able to implement. And that will persist. Whereas the widespread expectations will be those will go away under a Democratic administration. But personally, I am not playing or banking which party will actually become elected.
Thank you so much for that. Trust me, it's being discussed and debated as much in India as it is possibly in the US because everybody is watching whether Trump comes back or not.
Yes.
Uh, but sir, because we were talking about the kind of stimulus and the kind of support the government's done, at the same time, many feel that the jobs data, those kind of numbers have been worrying. In that sense, do you have a view on the rising household debt in India? Also, at the same time, uh, we've seen a whole decade of stress death for India, where companies completely got wiped out, over leveraged companies got wiped out. We saw ownership changes, all kinds of things happen. Um, do you think there will be a cause for concern in terms of both household debt and corporate debt for India?
In the case of corporate debt, I think if you really see since the turn of the millennium, there was a lot of investment happening in infrastructure, largely in power. And the government also allowed borrowing of a very high magnitude. The sort of debt equity ratio used to be 3:1 or 4:1. And so because of the policy uncertainty, there were lots of delays, land acquisition, policy uncertainty, and stuff like that. So therefore, if a company is over leveraged and thereafter they are not able to commence production, repeated restructuring happened, and thereafter quite a few of these companies have collapsed. So, and that is a case where in particular sectors, infrastructure sector, where there was over leverage. But if you, barring that, if you really see, Indian corporate sector is not terribly over leveraged. In fact, since the turn of the millennium, if you really see, most of these companies have raised equity almost repeatedly, and they have brought down the leverage, financial leverage, quite a lot, and that is why they are in a position to withstand this economic impact of the pandemic quite well. As far as banks are concerned, if you see the private sector banks, which generally are seen as better managed in India at least, so they have managed to raise a lot of capital in order to ensure that even if this pandemic continues for some more time, much more than what is currently sort of factored, they will be able to withstand and take the hit, whatever hit is required on the balance sheet. So they have strengthened balance sheets. Basically, Indian corporates have strengthened balance sheets, except the ones which were in the infrastructure sector where they got hit very badly because of delays. As far as household debt is concerned, if you really see, the average Indian is quite frugal. He doesn't borrow much. And if you see, even as far as housing is concerned, the total housing loans in India are probably less than a third of the total outstanding debt of the banking system. So therefore, it is not as if they have over leveraged. Yes, there have been job losses, and there have been some sort of forbearance given by most of the housing loan companies. I mean, at the prodding of the government and the RBI, and so therefore, it is not as if they have lost jobs permanently. So when the economy springs back into shape, I think they should get back into the line of the ones who are employed. So therefore, I think it's just a matter of probably a quarter or two, or maybe maximum 3 quarters, when their repayment capacity will come back into shape. So this short point is that Indian households are not over leveraged, like, say, for example, what is the case in most developed markets, where the credit card culture is and the EMI culture is rampant. Here it is not so much. EMI is there among the younger folk a bit, but even that is within limits, because banks have been very, very conservative in even lending based on EMI. So therefore, I think the household debt is not a matter of serious worry for India. And as I said, corporate debt, except the ones which had to, by design, had to be very highly leveraged, and they've virtually already collapsed, and they're already in insolvency courts. The others, I think, have taken the lesson very seriously, and they've capitalized themselves very well. So I don't think there is a huge reason for us to worry about corporate debt or household debt.
Thank you so much, Bhat sir. We're coming to the close of the questions that we have planned. So I can see some questions already collecting in the Q&A box. Trust me, I'll get them all answered. Before we go there, John, I just wanted to ask you about this, because we're seeing a lot of first-time investors entering markets both in India and US as their savings have risen during the pandemic because they still have jobs. the ease of investing and access to markets has improved sharply, but there is also the risk of these investors catching the end of the rally, the tail of the rally, as we call it. Is that a cause for concern, and what would your advice be to these kind of investors?
The biggest advice or the best wisdom I can pass on is that anytime you're invested in the stock market, you're subject to a potential 50% drop, 50% loss. And that's part and parcel of the expectations of having money invested in the stock market. In general, we don't know when that will come along, and our forecasting record of when those drops will actually come is really terrible. It's probably worse than just flipping a coin. Just as one really big example of that, since 2008, when the government did spend massive amounts of money to stimulate the economy, the best minds in the United States, the best economists, the best investment banks were absolutely convinced that that would kick off inflation and that would kick off a major drop in the stock market. And so the first year, second year, third year after 2008, nothing happened. The stock market started rising back toward new highs. People figured this was the average length of a run of a bull market, and we're basically saying, well, we're kind of at the tail end. Why invest now? The next year, the market went up. They were saying the same year. The next year, they said the same thing. And right now, the drop occurred completely unexpectedly, not for the reasons at all of what people expected because of the massive stimulus or runaway inflation, which clearly didn't happen. But we did have a drop, and then we had this historically quick recovery from it. So the best long-term wisdom is no, you should not be treating this as the tail end and people are getting in late. When you're putting money in the market, you should be committing it for a long-term point of view. You're looking for returns over many years, many decades, not many months. Newer investors tend to focus or hope they're going to double their money on investing in a stock in a year, maybe months, maybe just weeks. And usually that proves to be very misguided. It takes a lot of wisdom and experience and decades of investing experience to get away from that and say that we're looking for a long-term return, investment return. Maybe it's 7% on the extremely high side, a compounded 20% per year, but that doesn't happen each and every year. That's the total result. And during that time, both the individual stocks and the stock market indices as a whole, you're going to see these incredibly huge 50% drops, but not because somebody predicted it, or not because we're at the end of the run, or not because our bull market has extended well past average. The market has a mind of its own, basically, in terms of when it will go down, or like right now, when it is up. So I hope I've conveyed some wisdom in terms of looking at the stock market as a very long-term investment and totally expecting you will encounter several periods when your investments, your stocks, the stock indices will have dropped by 50%. That's not a time to panic. If anything, that may be a time to load up the market if you manage to have spare cash at that time. So no, they should not view this as you're investing near the end of the market. There could be other reasons for the drop, but not because of the amount of time, or not because of the fact that we're at new highs.
Thank you so much. I'm going to pin you both down to strategies now, because a lot of the people who have logged in are looking at strategies from both of you. But sir, for India, when you look at the green shoots in the Indian economy, which themes do you see playing out? And which are the sectors that will do well, obviously, but which are the sectors investors should definitely avoid at this point of time?
One of the most important lessons from the pandemic is that people have realized that they should keep distance. Social distancing is something that I think even if the pandemic were to miraculously disappear from tomorrow, people will left with this idea that social distancing is a good thing, that you should not really assemble in large numbers at the same place, and God forbid if someone coughs, I think it is worse than murder. So people people think that that's a prescription for death. So therefore, I think assembling in large places where you have other people at very close to each other, this is something to be avoided. So therefore, taking away and this is not something that will change just because the pandemic is officially reported to have left the shores of the country. It is not so. I think people continue to do this, and people are unlikely to assemble in great numbers anytime soon. Probably it will take years for this to happen. So therefore, all those businesses which need people to assemble are probably in danger for some years to come, at least a couple of years. What are these? These are things like cinema, airlines, commercial real estate, malls, and especially the big fat Indian wedding. I think all these are things of the past now. So therefore, things will probably they'll be more individualistic, and even probably most of these things will happen through webinars like this. So therefore, I think all those businesses which are relevant, which are requiring people to assemble, is complete no. The other thing, of course, is that where you are able to you're able to interact through the webinar or through the data network, work from home sort of thing. These are things that you continue to do well. So that is why you are seeing the IT companies doing well. The telecom companies, the sort of data consumption increase manifold. So therefore, they should be doing very well. The pharma companies, because there's always hope that there is either a cure or there is a vaccine around the corner. So therefore, the pharma companies will continue to do well. So I mean, these are the sort of investments that might be worth doing, and especially if there has got to be a pronounced growth in FY22 onwards, this growth has to be financed. So therefore, the banking system, especially the private sector banks, would probably continue to do well. NBFCs, I think still there is some sort of reservation because of the two spectacular failures there. But at least the private sector banking system should continue to do well. May not be this. I'm not saying this is the right time to buy, but there might be a correction. But at some time, I think if India has to grow in a robust way, I think somebody has to finance it. That is the private sector banks today. So these are the sort of areas where I think it might be worth investing. And the government is committed to modernize infrastructure. So therefore, there will always be engineering companies that will do well. There will be cement companies that will probably do very well, and the capital goods companies may do well. I mean, these are all companies which can be expected to do well, and all the other companies which are dependent on, as I said, people gathering together. These are some things to be avoided. So the whole trick is, because, say, for example, 8 months ago, nobody would have thought that airlines will suffer a crisis like this. I mean, it's an existential crisis. Or say commercial real estate, because of the work from home, if you see most of these metros, most of the buildings are occupied by IT companies and the BPOs. So therefore, this is going to be a thing in the past, because at least half of them will probably work from home and they can save on rent. So therefore, commercial real estate is going to be difficult. The sort of companies which were actually the darlings of the market, especially in the entertainment business, the physical entertainment, all these are going to be in bad shape. So therefore, I think it is very important. Even 8 months ago, when some of these companies looked extremely attractive, it should have been essential for us to have a diversified portfolio, and that is the one that would have saved us. Because even though the market has recovered almost all the losses that it made in March, there are lots of companies which are probably at 1/5 the price that was prevalent in February. And there are companies which are probably recovered most of the losses from March. So therefore, you have to really have a good, well-diversified portfolio. That is why Alphaniti has all these baskets that it puts out, because it requires experience to find out which are the ones that are negatively correlated. That is how we create a basket. And theme-based, where there are underlying themes which are probably evergreen. These are the sort of baskets that we should be investing in. So therefore, I think the short point is that you should invest in diversified portfolios of companies which have a promise much beyond the pandemic.
Thank you so much. Nicely slipped in there. John, you've written a book about studying history to figure out how you can come up with successful investment strategies. You've been studying this, you've been doing this for the last 25 years. what are some of your parting words of wisdom, at least from my questions, that you would like to share with the people who are on the webinar? What would be the wisdom that you would want to leave them with in terms of strategy for looking at something like a pandemic, which is a once in a lifetime? The last time it happened was the Spanish flu in 1980. So, any words of wisdom for us?
Some words of wisdom from my long-term
You've gotten muted. You've gotten muted, John.
some of the implications from the long-term studies of the market and leading investors that I've studied are one, you need to take a long-term view of the market, as I was mentioning earlier. It is not usually a successful strategy to just try to pick individual stocks and hope that that's going to double within very short periods of time. Equity investing is a long-term endeavor. It should be done steadily. It should be done regardless of what you see as the current market condition, because you're looking for long-term future results. And you should be ignoring, again, the 50% drops. I say that knowing that is very difficult for many and most humans to actually do. When the stock market drops 30, 40, 50%, it's easy to see that that is going to continue, that your entire investment is going to be wiped out. Yet historically, those prove to be, from a long-term point of view, the very best times even to invest in the market. Now, at one time, I thought I had that really great insight, and that I was only going to invest after the stock market dropped 30, 40, 50%. This happened to be in the early 90s in the US market. And I waited for years and years, and the stock market didn't go down. It kept going up and up and up, and never really did come back down to the levels at which I thought was the appropriate trigger. So in the end, the conclusion from that is you want to have steady investments in the market. You want to ignore even these big crises like pandemics. That may create a buying opportunity, but also you're investing long-term in economies, so your investment will pay off in the long term in the future. That's part of the wisdom from all. Um, Another thing is you want to buy based on fundamentals, not based on speculation. There should be a strong financial reason for after you investigate a company. If you are fortunately exposed to a company through your work and you think they're doing good, or your family is buying certain products and you observe it, that is a good reason to start to investigate a company, to invest on it. And then if it passes that screen, you want to look for fundamentals. Bhat had mentioned diversification. That is another important lesson and wisdom. Uh, there are different studies, but probably at the low end, you want to be diversified in at least 10 stocks, 16 stocks, different portfolio or baskets. Um, Another thing that's emerged over time, of course, is that particularly in the United States, a lot of money, a lot of investments are controlled by experts who are looking full time in investing and picking stocks, and have millions of dollars in computer technology each, in some cases billions of dollars, that are competing against you, the individual. So to offset that, what has happened is you've seen companies, of which the Alphaniti portfolios are one, where there are computers that are scanning, on your behalf, all of the stocks in the stock market to find those that have the best long-term trends that meet criterias like wide moat, or the technology leaders, or they have what we call dividend aristocrats that are pre-selected and save huge amounts of time and supply that needed diversification to the individual investor. And one of the wisdoms here is to take advantage of that, to put the technology on the side of the individual investor. So I think those are some of the key wisdoms that emerge from, I guess, my more than 30-year study and history of the leading successful investors in the stock market.
If I could just ask you to crystal ball gaze, I have a question in my in my chat box here. Which global trends will shape the world economy in the next 10 years post COVID-19? If you want to put on your, magician's hat and look at the crystal ball right now, any thoughts on that?
Well, the question was which types of
which global trends,
industries, which global trends?
Yeah.
One has to do with the technology, bringing people together and providing immense computer power. That is accelerating exponentially. Second has to do with the electrification of many things, in particular of cars. You've seen it across the world over the last 30 years in terms of appliances and the electrification of them. So that trend will certainly continue. And a third trend is there's an emphasis these days, at least in the United States, on picking stocks that have good government, good governance, and good social policies. And that trend will persist and increase internationally over the coming decade as well.
Thanks, John. But sir, one question from the audience again is: what are stock markets pricing in, and what are bond markets pricing in? It's a very general question, but if you could add to it and tell us what are the things that you think the stock markets are not factoring in yet, or what are the things that the bond markets are not factoring in yet. So you can add some balance to that question in India.
Yeah, well, the stock markets are pricing in, as I said, a sort of a near V-shaped recovery in early 2000 FY22. Today, as it is, that is what is priced in. There will be a huge recovery from 22, probably the first quarter of FY22. That is what is priced in. But if things go bad, if there is a second wave of the pandemic, which is not impossible. As you have seen in Europe, you have seen like most of the countries are again announcing lockdown now. So therefore, if something like that happens, I think that is not priced in. So therefore, if that were to happen, I think there could be a correction. Then, of course, so the outcome of what will happen, say, for example, to the foreign portfolio inflows, if there is going to be a potential showdown between China and the rest of the world, that is also not priced in. So it is. I mean, the market seems to think that everything will be fine. Nothing. I mean, they will just blink at each other and stop. But we do not know if that sort of goes out of control. Then I think that is priced in. Then the third thing that I think we could see is that how the insolvency and bankruptcy proceedings go. Like as of today, we don't have we have not had great progress there. But if that were to be accelerated, and if there is some sort of a amendment that is required in the act, that if that comes through, and if there is a quick disposal of such cases, then I think there will be lots of opportunities for companies to acquire these near bankrupt companies at a cheap price, and that can give a flip to quite a lot of these companies which are successful. So of course, I mean, these are all with respect to specific companies, but as far as the market itself is concerned, a huge interest rate rise is not factored in. There could be an interest rate, as I said, classical theories, economists think that there has to be a payback for all the quantitative easing, and it has to show up in terms of inflation and higher interest rates. That is not factored in because last 12 years, as John and I were discussing, nothing has happened. The highest sort of quantitative easing ever in history has happened in the world or in 2008, 9, 10, and nothing has happened to inflation. So therefore, if the classical economic theories are right, then there could be inflation. So, but that is not factored in. As far as the bond market is concerned, it looks like as if the bond market thinks that RBI will continue to be a benefactor for the markets. It will continue to pump in liquidity. It is not really factored in a situation where liquidity might be scarce. It is not factored in a situation where inflation might return. But as of today, it looks like as if everything will be honky-dory, and there will not be huge amount of stress on the bank balance sheets or on corporate balance sheets. These things have not been factored. I hope that is right. But if by any chance there are some more bankruptcies, some more stress in the banking system as a result of probably, God forbid, another phase, another wave of the pandemic, then I think all these can result in higher interest rates, and even RBI might not be able to control this beyond a point. So therefore, all these things are not factored. Both these bond market as also the equity market, none of the negatives are factored in. In fact, all the positives are factored in, but none of the negatives are factored in. So negatives have a strange way of popping up every now and then. So we don't know. It has not popped up still now, and hope it doesn't pop up.
Thank you so much, sir. I'm going to ask the last couple of questions. One was sent to me by a friend when I said I'm doing this webinar. John, if you could answer this. Gold has always been this preferred safe haven asset whenever something goes wrong in the world. We're even seeing central banks actually adding gold to their balance sheets at this point of time. Just to expand the question beyond just gold, is there a play for commodity-centric companies when we plan on how to invest for the recovery that will have to happen after COVID-19?
Basically, gold can or should be part of one's very broad diversification in investing classes. I can't necessarily predict that it's going to go up or down right now. If there's inflation, which really is not predicted, that could. On the other hand, it's been a traditional safe haven. So an allocation of portfolio up to maybe 5% might be considered prudent in something like gold. When you start to get into other commodities, like silver, it becomes a substitute that usually calls for more knowledge. And then if you really want to play commodities, I don't really know in the Indian market if you can do this. In the United States, you can invest in futures in oil, pork belly, corn, a variety of different things. And you can, of course, even get into futures on the stock market itself if you want to treat that as a commodity. But those require specialized knowledge and different playing. I would say a lot of even sophisticated investors have been caught with commodities going very different than expectations. Energy in particular is one. And then we've had very different effects in the different commodity markets of agriculture, depending if United States, if Trump is supporting it or China cuts down imports, or of course, weather is a huge factor with many agricultural economies, and most retail investors are not at all prepared to know what's essentially happening in those areas to invest. So gold, again, probably deserves to be a small portion of one's portfolio, but the additional commodities are a very difficult class to successfully invest in.
Tell you for a fact that most Indian households, apart from their homes, the bulk of their savings would be in gold. It's just how it's been. But we do have commodity futures and options market, but tend to track either the US or the UK market. So one last question, and it's almost philosophical, that the last question that came in from the audience was that very simply saying, we've been talking about all of this. What does this mean for investor portfolios? What actions will you suggest investors take? I know you both touched upon it, but maybe this would be a good way to, close out the webinar. First, Bhat sir, then John.
Well, two things. One is that you should have a diversified portfolio of stocks. You should not be concentrating on single stocks or on single sectors. You should have a reasonably well diversified portfolio of stocks, and invest not more than probably about 40-50% in stocks. Don't invest everything in stocks. You have to have other fixed income instruments, maybe commodities, maybe real estate. All these are important. So you cannot really concentrate on one asset class. You have to be diversified amongst all asset classes, and you should always have enough cash. to buy into equities when there is a crash. So you don't know when it will happen. But if it happens, as 2008 has shown, when there is a 60% correction like what happened in 2008, I think if you had bought, you would have made tons of money. So therefore, you should always have enough cash in fixed income securities, possibly, to be able to capitalize on any such opportunities. So therefore, that is why if you invest only 40% in equities and the rest in fixed income and real estate and commodities, I think you will have that wherewithal to capitalize on any opportunities that arise in any of these asset classes suddenly. I think that's the way to go.
John?
It probably shouldn't surprise anyone that considering that we have the same international viewpoint, that I could, again, almost identically repeat what Bhat has said or recommended, almost word for word. It's been outstanding. The only thing I would add is within the sector of the investing for equity is that the investors take advantage of the pre-diversified packages or baskets that are presented for them, and view those as long-term investments that you're writing out to achieve the return of that particular asset class within your diversified portfolio. People, again, at this time, it's not clear people should be spending time looking or investigating individual stocks so much as they should be picking baskets and themes that are diversified for them. And by selecting several, you're actually diversifying among your a number of different asset classes as well. So that would be my suggestion or recommendation.
Thank you so much, John, and thank you so much, Bhat sir. That's it from me. I hope this was useful. We spoke about a gamut of things. It was very, very interesting to see two very intelligent people who I can tell you for a fact they haven't spoken before the webinar, coming to almost identical thought processes about how we should be navigating this pandemic. Thank you so much for having me here.
Bye-bye.
Bye-bye now. It's been a pleasure.
Bye-bye. Bye-bye.
Hi, John. Thank you so much.
Thank you. Thank you.